type of mutual fund schemes based on investment objectives or based on the domain in which they invest, like fund manager can invest in shares, or fund manager can invest in bonds or debentures, or they will prefer money market, or they can invest in gold, etc. So based on the place they invest, we can classify schemes into various types. So in the coming slides, we will be seeing about different schemes or different funds that are available to investors to pick from. So let us start, and the first fund is equity funds. Equity funds are basically funds which invest in stock market, and the rule says that to classify as an equity fund, a fund should invest minimum 65% in equity market. Since they invest in equity market or stock market, these funds carry high risk. Obviously, there is a possibility of higher returns also. And there are so many subcategories available in equity, like mid cap, small cap, large cap, etc., that we will be seeing later on. The next fund is debt fund. Debt fund is a fund which invests in debt instruments. We also call as fixed income instruments, like we have bonds, we have debentures, we have government bonds. These bonds or debentures, they offer fixed income, also known as coupon, which is also known as interest income. So a mutual fund which invests in fixed income securities like bonds or debentures, they are known as debt mutual fund schemes. These schemes are not suitable for capital appreciation. Generally, they are preferred for capital preservation, whereas equity schemes are suitable for capital appreciation, because equity schemes, they have the capability to offer higher returns. Of course, there is a risk element too, but they are capable of offering higher returns. So we prefer equity schemes for capital appreciation. That's why equity schemes are meant for long term. Whereas debt schemes, they are not meant for capital appreciation. Rather, the main objective of debt schemes or fixed income schemes is to preserve your capital. Comparatively, they are less risky. Comparatively, they are less risky. In the sense, they are less risky than equity funds. And the third category of fund is liquid funds. It is a special category of debt fund. Liquid funds are those where the funds are invested in money market. Money market is a market where the maturity is less than 1 year. So liquid funds are mainly used by corporates to park their short-term surplus amount. Liquid funds can also be seen as an alternative to your savings bank account. Normally, we use savings bank account for contingency purpose, for day-to-day withdrawal purpose. Similarly, liquid funds can be used as an alternative to savings bank account. We can place short-term surplus in liquid funds. So that is the main purpose of liquid funds. It is a special category of debt funds, and it is the safest of all mutual fund schemes. It is the safest of all mutual fund schemes. And the last variant would be gold funds. Gold funds, they invest in gold. There are two variants again we have gold ETF, and the other type is gold savings fund. Here investors pool their money and it is given to the fund manager. The fund manager in turn will invest in gold. So the returns depends on the returns from gold. Thank you.